Thank you very much to our first panel of the day. Really interesting discussion and trying to put a bit of order to that electric vehicle chaos here in Europe. Up next, we have a panel titled Pricing the Unpriceable, Climate Risk Software for an Era of Annual Once-in-a-Century Disasters. Big topic. Welcoming to the stage to tackle this topic, I welcome Nigel McCleave, partner at Lightrock, Viktor Gauk, CFO and Managing Director at OroraTech, Dr. Alex Marti, CEO and co-founder of Mitiga Solutions, and to keep the session in line, we welcome Greg Wasserman, Head of Private Climate Investing at Wellington, to chair this session. Let's give them a nice warm welcome to the stage.
Welcome everybody to the best panel of this whole event. It's interesting because this is actually a little bit of a provocative title, this question of pricing the unpriceable. And I think for anyone that watches the news or watches TV, everyone knows that all these climate events with heat, storm, fire, drought, flood just keep happening more and more. And the concept of the once-in-a-100-year event, which is historically where insurers and other asset owners have priced risk, is now happening. It feels like daily. And so the question is, are the historical models fundamentally broken? Which the answer is clearly yes, and therefore is climate risk unpriceable? And I think up until somewhat recently, the answer has probably been yes. Just there haven't been good ways to actually price it, and people have been a little bit stuck. But if you look at what's happened over the last number of years, with better data, better analytics, incredible founders building interesting tech, and investors giving them capital to build. We're actually in a world where you actually can price it, and you can understand the risk, and can essentially plan your infrastructure and your assets and your operations around that. And so that's really where we will focus for this panel. I'll start with just background for myself. Greg Wasserman. I lead the climate growth investing team at Wellington, which is a large global investment manager. My focus is on companies that are solving climate solutions at the growth stage, so typically Series B through D. Really have product market fit and are rapidly scaling. We tend to really focus where there are solutions that just use existing tech to unlock better performance from infrastructure and assets that are already out there. And I'll ask my fellow panelists to introduce themselves.
Sure you go. Yeah. Good morning, everyone. My name is Alejandro Marti. I'm the CEO and co-founder of Mitiga. Mitiga is a climate tech based in Barcelona. We basically focus on providing modeling for predicting climate risk on the physical built environment. That goes from wildfires, flood, to severe convective storms. We look in temporal scales that are climate, so not so much on the weathers. And in particular, we look more into the critical infrastructure. So that will go from energy to telecommunications, construction, and so forth.
My name is Viktor Gauk. I'm the CFO and Managing Director of OroraTech. We operate a satellite network for thermal anomalies. One of such anomalies are wildfires. We're probably going to talk about that today as well. But we go beyond that, measure the temperature of the sea surface and derive analytics from that, informing critical infrastructure providers, but also emergency services and other utilities.
I'm Nigel McCleave. I'm a partner at Lightrock. Very similar to Greg, growth equity investor. We're headquartered in London, manage about $6 billion AUM, including a $1 billion climate fund that focuses on growth equity investments in Series B plus companies.
Awesome. So let's level set for a little bit and just talk just basics for what we're actually talking about here. The concept of climate risk and pricing climate analytics and things like that. It's become really important in the world because I think for all of the efforts to mitigate the causes of climate change and decarbonize and all the efforts that everyone around the world is doing other than the US at the moment, reality is that alone is not going to be enough. And while we are decarbonizing, we need to become more resilient to the impacts of climate change because reality is it's not even a thing that's coming. I think it's already here. And the concept of climate risk is really, I think, the most important part of adaptation technology, right? You cannot protect yourself against risks and events if you don't actually understand what your risk is to begin with. And so this is really the very foundational part of, I think, building a more resilient society. And so Maybe I'll kick off with start with Alex, and then we can go to Viktor. Just level set with us a little bit around just what is, when we talk about climate risk and climate risk assessment, what exactly does that mean? What sorts of things go into that? How do customers use it? And then just where are we in the cycle of adoption? Is this broadly adopted? Is it just scraping the surface? Just help us level set a bit.
And when we talk about climate risk, at least from our lenses, we're talking about the probability of events to happen in a period of time. You were talking about return periods before, no? So like 1 in 2 years, 1 in 5 years, in 10 years, in 20 years. And to understand not only what's the probability of that event to happen, but also what's going to be the damage caused by the event and the actual loss associated to that, no? So when we do these climate models, basically what we tried is to build comfort to those clients to understand what that risk is going to be. And what I mean by that is models, as we know in many other industries as well, they don't drive solutions, or they don't drive decisions. Confidence does. So in order to do that, you need to actually build trust. And to build trust, you need to start by being transparent about the models. A lot of people think that, by showing that models, they have certain uncertainty, you have weakness into your models, and it's all the contrary, right? So, if you show that your risk for your house to be flooded is 73, but I don't tell you what the uncertainty is, it can be 73 plus minus 73, which is the same than flipping a coin. So what we tried is to provide you that 73, but that plus minus 10. So when you make decisions, like anything in life, you have the contingencies associated to the uncertainty, and then we open those models for you to understand that the science behind is backing those models, and then ultimately you can make decisions, because climate risk is not only just climate risk, it's a financial risk. So you need to be able to embed it into that OPEX and CAPEX in your decision.
Yeah, we work a lot on the operational side, basically with the result, with the outcome of the climate risk. So we work a lot with customers, with fire agencies, emergency agencies, where they face obviously the outcome of the global warming. And so in this particular case, it's a lot about timing, a lot about how to not only to prevent, but how to act on actual outcome. So is it a fire, is it a propagation, the outcome? And here we see a lot of immediate action required to tackle that. And obviously we have this correlation that the better you are prepared for something, the better you can act on it. And this is where we see the most impact on the operational side. Be really prepared with modeling, with what's going to happen next, and once it happens, really take the right action.
And what, Alex, if I go back to something that you were talking about when you just made the point about, it's climate risk, but it's also financial risk, and helping people understand that. What's the biggest barrier to getting customers to adopt this when you're pitching them? Is it, do they question the underlying models and how they know if it's real? Is it, there's a bit of human nature that this is so, you're talking about 20, 30, 40, 50-year risk that, I'm not even going to be here then at the company, and so what do I care? And getting people to think that far, or, is it sometimes more tangible that, 73 plus or minus 10, like, what do I do with that? Mm-hmm. And just how you get customers over the hump with, whatever the pushbacks you hear on the sale are, and what are the key barriers and the key unlocks?
Sure. We have seen an inflection point, to the point that I think it's even a tipping point where there is no return, where like this climate agenda is already in the C-level top 5 priorities. No? So they know that climate risk is something that it has a financial impact into their budgets, and they don't know when it's going to happen, but they know it might happen, or it already has happened. I think back into what we mentioned before, if you are transparent about the models and the client is able to understand what that 73 means and what the contingents associated to that, I think the underlying models and the assumptions are accepted. If as long as you have your scientific background and so forth. No? What it gets a little bit more challenging is when you need to translate that into those financial decisions. No? So in our case, we have something that is called climate value at risk, where we just don't take the probability of the event to take place, but we translate it into financial metrics, understanding on what's the vulnerability of the asset that you have, not only from a physical point of view, so percentage of the asset that is going to be unavailable, but how is going to affect downstream, no, on your operations, on your business interruption. No? That's the work that needs to be continued on in the sense of helping clients to translate that into financial metrics that then they can put an ROI. Because at the end of the day, it's all about being able to either make more money or lose less money.
Yeah, got it. And how about you? Just again, same question. You're coming from a different perspective, but
Yeah.
what are you hearing from the on the sales side and just what the barriers are and how you get through them?
Yeah, I mean, it goes in a similar direction. So we see in this disaster monitoring, disaster management, a certain pattern. You have the preparation phase because you know you're going to face that, and you have the action phase, and then you have the, let's say, post assessment phase. And obviously in the preparation phase, you use the models, you try to predict, to apply those, and the level of trust is the most important point. So you can run as best models as you can, but if the day comes when the flood, the fire appears, the model needs to be working. And if you can prove that it works, then you gain the trust of the really people on the operational side. However, this is a certain contradiction between being a startup, implementing something new, using AI, using this new way of modeling, versus silverbacks sitting, having the knowledge for 30, 40 years, and now all of a sudden need to trust something which they haven't used before. And this is a process which goes over the whole cycle. The cycle is usually at least a year, where you need to prove that what you have modeled before really delivers you the proof points during the event.
Got it. Nigel, maybe changing gears and flipping to you for a second. The investor's perspective is really interesting because you see a wide lens of lots of companies coming at this problem from different angles, whether it's broad climate risk, whether they're going after specific perils, and you just see a broad universe. What are your observations on, what you find interesting, where the space is, what sorts of business models excite you the most?
Yeah, I mean, and so like divorcing that question from like the stage piece, which we're relatively late stage compared to venture, relatively early stage compared to private equity. I think there's types of capital for everyone from a stage perspective out there. I think from where we sit, so I think the question around what is attractive about climate risk software companies, the first thing you look at is the word climate, because climate is like a label that I think is convenient, but not hugely functional for people who own budgets, right? Unless they have a climate agenda which someone's paying for. And so I think what
in the US, you get put in jail if you use the word climate.
Right, exactly. And you joke, but it's hilarious actually for a lot of software companies today. Their contracts in Europe or in different states in America are actually worded differently to avoid being ESG or climate, which is crazy, but anyway, it's the world we live in. I think the biggest thing in this space for me is there have been companies doing this for a while and trying to do this for a while, and I think kudos to you guys for still being here and making progress. So I think the biggest thing with anything with climate in front of it is the world is full of people wanting to do the right thing and create good companies that are solving real problems. The world is slightly less full of decision makers at potential clients who are willing to spend a portion of their budget on that, right? So for the big thing we look for is who actually cares now and why. And I think there have been companies in this space that have been and gone that had beautiful products and beautiful solutions to a problem that was maybe 10 years in the future in a corporate purchaser's mind. So typically for us that displays revenue, but it goes deeper than that. It's who is a sponsor in the organization? Are they a decision maker, or do they need to get someone to buy in? And what does that look like? And that's really challenging for guys like this because it comes and goes with the sentiment of whatever country, whatever organization you're in. We have an investment in wind, which if someone else had won the election would be doing super well right now, right? And so I think being resilient to kind of weather those shocks of sentiment and have some people who really view your problem as a now problem, I think are probably the biggest things in this specific space, because there's a lot of fabulous companies with fabulous products and solutions to problems that maybe haven't been fully formalized within a purchase yet.
It's interesting because, to your point, in a lot of ways, this space should be most immune to the politics, right? Because it's not about, people brand it climate, but it's not about whether you believe climate or not or what your politics are. It's the fact that there's a fire outside and you have to deal with it.
But that point, it's not just a purely political one. It's that problem even for a very liberal climate change believing person in a corporation. It may not be super distinct to the point you guys were making earlier about how that impacts their P&L in the reporting period that they have to worry about, and then why would I spend money on it if it doesn't, right? Not everyone in companies is thinking 10 years, 20 years strategically, right? And I think that's probably the biggest barrier. Or if companies are able to demonstrate they've broken down that barrier and demonstrate people saying, we changed X, Y, and Z process because of the data X, Y, and Z company provided us, that's like a really good proof point.
Are you guys seeing on the sales side that companies have to learn this the hard way by actually getting hit by something and then they act? It's almost like kids need to learn the hard lesson before they actually learn from it. And maybe in the world of these events happening more and more, company actually has a facility get damaged or burned down or whatever it is. And then they say, okay, now I actually need to go do something about this. Like, are you seeing that or not? Not really.
Yes. But it's changing, no? I mean, if we look at the title of the panel, I mean, we're trying to convince companies to act on something that it could happen in, as you're saying, 30, 40, 50, 100 years, no? But let's think about this. We are in the business of supporting companies to understand that 10% of the events cause 90% of the damage. No? So climate risk is not something that should go in a time frame of 4 years because one legislation or another. It should go long term, and those investments, they need to happen long term as well. Obviously, those companies that they already have had a loss, they understand what it means. And they understand that investing in that 10% resilience, it gives them, business continuity for, much more than that. The other ones, it's a conversation that you need to have with them. I think the reporting and disclosures has helped a little bit. It's eye-opening for a lot of companies that at least now they have reports that they say, hey, this could happen. And okay, the sustainability person checks the box, that document is there, but if it happens and the risk person hasn't done anything about it, it's not that he can or she can say, I didn't know. No? So that conversation is changing a little bit, but there is still a lot of work to be done.
Awesome. Let's pivot for a second. I'll open this up to all of you. Welcome your thoughts here. What's always the topic of the day, I think these days, is AI. And so in the context of climate risk analytics, which is very data intensive, very forecast driven, a lot of complex math behind it, it feels like there should be huge potential for the quality of what analytics you can do and how you can incorporate that into decision making, really, getting a step change now that AI is out there. And so what have you guys been seeing, both for you guys on what you can do with the product with where AI is and currently heading, and maybe for Nigel, just what you're seeing in the investment universe with opportunities that maybe you wouldn't have seen companies attempting to raise to do this in the past, but you're
yeah, I mean, as it relates to kind of this space specifically, I think I talk generally, then you speak specifics. I think the two things that I think probably apply most to these guys is one, what does AI do? It allows you to draw insights from data in a more intuitive and a quicker way. So I would view that as a tailwind, both a tailwind and a threat, but I'll come back to how that threat's mitigated in a minute for you guys, because either you guys are able to generate far more insights for your clients with fewer resources in a more efficient way, or your clients are able to do more themselves with the data you provide them. The other thing, which I think is potentially a moat for you guys, and people in this space is, people talk about AI and the insights, but that's not very helpful if you don't have good quality data. So I think, on one end, the folks who are building their own proprietary data collection, that's a strong moat. But I think beyond that, the folks who are bringing in data, even if it's not their proprietary data, and packaging it in ways that enable AI to process it more efficiently, is not just a problem or an opportunity for companies like this, but across the whole space, right? Because so much of AI is built on crappy data today. And so I think that is probably where, how I'd say it most affecting this particular space and some other spaces too.
Yeah, maybe you can build on that, because you guys have proprietary data with what you've done on the satellite side, and maybe you could loop that into your
Absolutely. So I think there are 2 points to that. And so right now we are at the stage where AI can help faster process the data, proprietary data, build more robust models, build the trust into the analytics, but where it's going to help in future and really make the shift is the decision making, because this is something where right now this all happens at at the personal level, at the human level, and there is no trust into that part, because it's very risky to say whether the left side of the street is going to burn down or the right side, who's going to make this decision and who's going to take the consequences out of that. But this is exactly where the development is going to go, so that we go from analytics, faster processing, making better models, to really decision making, maybe on behalf of the person who is sitting there, reduce maybe false decisions, and take it to the next level. We are not there yet, but I think that's exactly where AI needs to take us.
Yeah, and to Nigel's point before, I mean, if climate or sustainability is a buzzword, AI is the next thing over, no? So I think there are things that we need to understand about AI. I mean, we've been using AI for the last decade. I mean, first generation, second generation AI, there is machine learning, transfer learning, neural networks. So I mean, models have been taking advantage of those things for a while. Now people associate AI with conversational AI, or agents, which they're helping as well. But let's not forget, and you were making this point now, that AI is using data from the past. It's data that, so the same thing that in climate modeling, historically, companies have been using data from the last 10 or 100 years trying to predict the next 10 years. That doesn't really work, no? I mean, we're seeing that, and I think there is a report from the UN that was saying that in the next 5 years, we're going to see double the number of climate events that we have seen since 1990. So climate is coming, but we cannot depend on the data on the past to actually predict the future. So AI, to Viktor's point, is very useful in terms of optimization, velocity on the computational models, getting some retrievals from the data that maybe otherwise you cannot get, but it's definitely not going to replace the space.
Yeah.
I think to your point, I don't know if you saw this company, Greg, or you guys know it, but in this space a few years ago, we actually looked at a company called climate.ai.
Yep.
Yeah. Yeah.
Basically, any company that does anything with data, or I don't know if anyone saw the Allbirds announcement.
Yeah.
Allbirds just flipped from being a shoe company to AI company and GPU marketplace, and it went up 10x in value. So everything's AI these days.
I think now it's more expensive to get your domain.ai than to
it
get
is,
it .com, just because it gives you some.
Yeah, maybe just to rehash some of the discussion we were having about there, because we were chatting about just randomly about insurance, and I think insurance has been really frustrating in a lot of ways, because when you think about who has the risk and who is best positioned to price the risk, right? It's the asset owner or the company or the corporate or whoever, or the homeowner, any one of us, that actually holds the risk. The entity that should be best at actually pricing the risk is insurance or banks, because they're actually making a coverage or a lending decision around that. But I feel like that concept that they should be the ones best positioned for the pricing risk is probably true for anyone that hasn't spent time in climate risk analytics. And then for anyone that's spent time deep in there, you realize that actually, it's really hard getting insurers to properly price everything. And so what have you guys been seeing around just insurance, and why it's not so obvious that they should be adopting this more to drive pricing, and what some of the barriers are and how we can break through that?
Yeah, we had this discussion previously. Obviously, the perception is that the insurance companies should know it best. However, we see that the insurance companies are really hesitant of changing models, changing habits, changing prediction models, and we have been talking also to many companies how to improve the models with proprietary data, fusing in additional insights, real-time data into the models. But we feel that there is still a hesitance, and they would rather not change the model than improve the model and charge a higher premium for insuring something that they have not insured before. So also hoping here that with more reliable data, more real-time data, more AI, better processing, we get also the insurance sector to think about it and rethink the modeling.
You would think that the insurance sector is a sector that likes to be ahead of the game, and they are way behind the game. No, and apologies already if there is anyone from the insurance sector, but I mean, I think I've been fighting with them for way too long to just not be honest about it. And we were making this joke before we get into the panel that the insurance sector rather to be collectively wrong than right individually. No, so they protect each other in a way, like if you're not underwriting this risk, I'm not underwriting this risk. But we get into a point that the divisions of property and casualty, they're not sustainable whether, if they're not changed their way to look at risk. No? What it cannot be is that you're pricing risk based on if there is a tropical cyclone and the whole industry changes because of that. It doesn't mean that there's going to be more or less tropical cyclones because just happened one. No? Mm-hmm. So I think there are some green views on there where, like parametric insurance, I think is something that it's a little bit promising. I said the same thing 5 years ago, so I'm still having hope for that. But parametric insurance seems to be, one of the ways to revert this. But again, long way to go for them.
Yeah, and they have the benefit of being able to reprice every year, right? If you're the homeowner, you own the house for, perpetuity until you can sell it. Or if you're a company building a manufacturing plant, that's yours for 50 years versus insurers can reprice it every year. And so
right.
If they realize the risk is actually going up each time, they can just reprice it. We just clocked down to 0, so I think that's probably picture perfect timing on the panel side. I don't know if we have time for questions or if anyone has any questions. We answered everything so thoroughly. Mm-hmm. Awesome. Well, thank you, everyone,
right.
And enjoy the rest of the conference.
Thank you.
Wonderful. Thank you very much.
Take the glasses.
Spot on time.